Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We've got a repeat guest. Is this third time on the show, I think?
I think it is the third time, Brian. I think that's right.
It is the third time on the show. I think I brought you on as an aspiring investor so long ago, and then flipped the script. But yeah, that was quite a while ago. So anyway, we got Lee Yoder here for everybody else. Lee, welcome to the show.
Yeah, thanks for having me back, Brian. It's always fun.
Absolutely. Absolutely. So let's do this. Let's talk a little bit about your background and what got you into multifamily.
Yeah, sure. That goes all the way back to 2017. Well, even 2016, I guess. I was a physical therapist, but I really actually wasn't even practicing physical therapy. I was kind of come in the office out of the field of physical therapy and was kind of acting like a director of operations type role with a startup company in Cincinnati, Ohio, here where I live. And it was a startup company that was just booming. And I was really enjoying the work because I was kind of like building. It was the first kind of entrepreneurial position that I had, and I was just loving it. But it just wasn't great for the family. My wife and I were starting our family. We had two young kids. You know, she was staying home with them. Actually, she's an RN, but she was just working PRN. So, you know, the more I was at work and the more I was kind of working overtime, she was working overtime with two young kids. And it's just not the life that we felt like God was calling us to. So just kind of started looking around. I mean, it wasn't like I was running from that job. I actually, again, I really enjoyed it. I really enjoyed the people I worked for and the people I worked with. It just felt like, man, I don't know that I'm going to want to hustle like this long term. That being said, like I wanted to hustle, but I guess I just wanted to control it more, right? I mean, what people talk about, that financial freedom that leads to time freedom. And it felt like, because I was actually moving toward a promotion, and I had talked to my boss, the VP of the company. I said, am I going to be able to kind of keep my hours? Because I was kind of doing something different for the company since I came in as a physical therapist, a little bit different. And I was leaving between 5 and 5:30 to get home every day, while a lot of people stayed maybe an hour, hour and a half later than that. And the job I was moving into, I was going to be managing some of those people. So he was like, no, you're going to have to be here when the people you're managing are still here. So you're going to have to stay. And that was kind of a line in the sand for me. Just is like, that's just too much time away from home. I'm not willing to keep doing that and do it, you know, even more. So started looking around, Brian. And I didn't know where I was going to go, because going back to just doing home health physical therapy just felt like that was unacceptable to me. I just didn't want to do that. I had done it before, and I wasn't passionate about it. And now that I like kind of found like, man, this is the type of work I'm passionate about. That's what I wanted to do. I wanted to build something. I wanted, you know, maybe something more entrepreneurial. So started networking with people, you know, talking to different people. One guy from my church, he was in real estate full time. You know, we were pretty good friends, and what he did, you know, seemed very interesting to me. So I had lunch with him. You know, the more he talked, I'm like, man, I think I could be interested in that. My dad's in construction, so I grew up around construction. I've been in construction in college. So just all that kind of stuff with the real estate really spoke to me. And my friend was like, Lee, could your job be more flexible? Could you do it from home? Well, the job I was doing, as I kind of just explained, the answer was no. I was heading toward being in the office even more. So I thought, well, okay, well, what if I do go back to being a physical therapist? I go back to doing home health physical therapy, where I drive around to people's homes and my schedule's very flexible. I make my own schedule, all this stuff. Then I would have that flexibility that my friend was telling me I would need to start a real estate side hustle. So that's what I did. I went back to home health physical therapy, and I started getting into real estate. And again, I'm driving around to people's homes. So I'm listening to podcasts like this one, Brian, just, you know, listen to audio books, like learning. And then I'm calling brokers, and in my free time, I'm underwriting and trying to learn that. And so just absorbing. And so it was less than a year, we flipped a house. So that was in 2017. We flipped a house. Was like, okay, this isn't what I was trying to get into. And my wife's like, hey, this isn't passive income. You were telling me about like passive income. So we're like, all right, well, let's not do that again. Work. Yeah, right. A lot of work. And then we sold it, and now what? You know, it's gone. So we did a duplex in 2018, kind of sold that proof of concept. We didn't even hold that for a year, but for some of the time it was rented, and the income was more than all the expenses, including the debt. And so it's like, we're making money and they're paying off the debt. Like, this is what we're talking about. But I'm like, man, how many duplexes am I going to have to get? How many more times am I going to have to do this to like make meaningful money? I mean, we might've been making $200 per unit, which is great. I mean, if I was doing that with the units I own today, it'd be awesome. You know, you don't make as much per unit when you own more units, but still $400 a month, $4,800 a year. It's like, man, I'm gonna have to do a lot of these.
Needle.
Right. It's like, man, I'm going to need 20 of these to start looking at some financial freedom. And I didn't want to do 20 duplexes. I mean, maybe some people do. Some people might go, oh, geez, 20 duplexes. Okay, I can, you know, great. I didn't want to do that. So I was like, man, what's next? So Again, learning. There's a RIA in Cincinnati, Real Estate Investors Association. Started going to that. They had an apartment focus group. There was a guy there teaching that group, and once a month teaching us how to underwrite multifamily properties. So I was learning from him, underwriting, sending my stuff. And by 2019, I got a 16 unit. Again, this is all local, Cincinnati, Dayton, Ohio, where I live. I brought him in on that with me because, he was kind of a mentor, and gave him 10% of the deal. So he'd come and do the inspection with me and help me negotiate and all this stuff. And then, I was off and running, and month and a half after that, got an 8 unit, month and a half after that, got a 10 unit.
Slow down and kind of dive into those. I mean,
yeah, sure.
I mean, duplex is pretty easy to conceptualize, right? I mean, most people can handle that. So you're talking 16 units. Let's talk about a little more specifics, how you structured those, how you funded those, and then we'll move on to the funner stuff.
It's a good point to stop, Brian, because you're absolutely right. I mean, it was scary to do the first flip. It was the first thing we'd ever done. The duplex was kind of scary too. Okay, first time we've had renters, but jumping up to a 16 unit felt like climbing Mount Everest to me and definitely my wife. So it really came all into network. I mean, this is where it comes in. People talk about it's a team sport. You got to network, go learn from people who have already done what you're doing. This guy that I was learning from at the RIA, Mark, I think he had bought a 12 unit, a 25 unit, and a 40 unit. He had gone to some boot camps. I know you do education, Brian. Like he had done that. And so then he was like passing it on to me. And then again, like I said, I was like, Mark, I'm just going to give you some of the deal. Like just because you've helped me so much already and I want you to keep helping me. And I couldn't have done it without him, Brian. I mean, that's where, like you said, I would tell most people, like, you could probably go do a duplex. I mean, because worst case scenario, like you're going to be paying the mortgage of the duplex and the mortgage of your house. Like that's where my wife and I were at. We're like, we can afford that. So it's okay. If we flip this house, we can't do anything with it. We'll just pay down the mortgage. I mean, that's worst case scenario. 16 unit, different story as you start getting in this. So we wanted people involved. And then the other part of that, Brian, was like, we were so nervous to manage that and really didn't want to. The duplex wasn't hard, but we did not enjoy managing that. So we brought in a property management company. And I always tell people this 16 unit felt like Mount Everest to us, but we brought in a property management company, not a giant one. They managed like 1,000 units, but all in that area. But 16 is 1.6% of 1,000, right? So for them, that's nothing. And I could tell that. And so that felt like, wow, okay, they're the ones that's going to manage it. They manage 1,000 units. This is easy for them. It's no big deal for them to come out, because my wife and I were like, what's actually going to happen when we take over this property? It just felt so overwhelming. But, having a mentor with us who had done it before, him right there, having a property management company, done it hundreds of times before, had 1,000 units. It's like, okay, they're going to handle this stuff. That's what allowed us to get over that hump.
Yeah. Now with the property management company, this has always been, I think the most frustrating thing I've had over, 6 years I've been in multifamily is the property management company, the property management companies themselves, here's things from a different lens. I want to hear your thoughts about it. If it's only 1.6 of their 1,000 unit portfolio, what's in it for them? I mean, what makes them keep going out to the property?
Yeah, it is their business. They have different employees. So the employee that might be over this, they're not managing 1,000 units. So they've got a smaller portfolio that they manage. And so I think there are good ones. I will tell you, I was extremely involved. So I ended up like just not feeling like they could handle the construction management. So I did that and I wanted to do that. So, we brought property management in-house last year because I ended up being pretty frustrated. Now, as we moved into bigger properties, we started working with a property management company that manages 12,000 units in the area. And so, we have 350 units today, but that's still a very small piece of their pie. We did experience some of that. I don't think you're wrong at all, Brian. I think if you're going to use property management, you got to know, like, you're still very involved. Like, managing the manager is a lot. And there just might be a lot of things that you think and rightly think that the property management company should do, and they're not going to do. And if you want the property to run really well, you're going to need to step in and do it. And that's what we did early on. We always did that. And then we just said, well, then we'll just do it ourselves. So if you want to scale quickly, I do think not bringing property management in-house is a helpful way to scale quickly, because that's another business. That is a separate business. So if you say, well, I want to manage myself and scale portfolio, I think you're building two companies at the same time. If you want to do it, fine. Like there's a bunch of people that do it that way. I chose to scale one company, which, is an asset management company, a private equity company that buys property and manages them from like an asset management level, and not have to build a property management company. And then later I said, okay, I kind of got this company running. Let me build a property management company.
Yeah, that is the right order. I mean, for what we're doing, this is the Diary of an Apartment Investor podcast, not the apartment, property management podcast, right?
Right.
But for what we're doing, I think that is right. If you want to scale, you can't be bogged down in the day-to-day management.
Yeah.
But on the flip side, you can't just hand it over to a property management company and expect them to take care of it.
Yeah, I think that's right. Yep.
You got to be somewhere in between, depending on the
Mhm.
property manager is the right answer. But the biggest struggles we've had have been with the management side, and getting property management companies that actually care
Yeah.
care about your property. Kind of been one of the rubs. So,
Yep.
well, cool. So you started building up the portfolio, adding more units on and whatnot. You had third party management running it. Let's kind of take it from there
Yeah.
and how it, basically where you left off and pick it right back up again.
Yeah, sure. So those three properties, 34 units between three properties, heavily involved in them. They were big value add projects. We put a lot of time, energy, money into them, big turnaround efforts. And so by 2020, a year later, I was just ready to go all in. I was still, full time as a home health physical therapist. Now, COVID affected me a lot in that all of a sudden, a lot of the home health stuff was kind of shut down because a lot of what we do is treat people in their homes after they've had a total hip or total knee replacement, other
Mhm.
surgeries, and a lot of that stopped happening. Those are elective surgeries, and so you weren't allowed to do those during COVID. So I was working very little as a physical therapist, which I was thrilled with because they paid me per visit, my
Mhm.
company. So it wasn't like, they were trying to get me work and I wasn't trying to get, the visits. So I was letting my colleagues have all the visits because there weren't very many to go around. I'm like, yeah, you guys take them. If you need to make money, you take the visits. I'll go do
Mhm.
real estate. So that was kind of cool. So I was just so ready to go all in, Brian. So
Mhm.
I told my wife, originally the plan was like, hey, we're going to build up a portfolio that replaces my income or at least pays our expenses. We were maybe halfway there with the portfolio we had, or we were on our way to being halfway there. The properties weren't fully turned around, but like by the time we would have got them all the way turned around, we would maybe like be halfway there to just covering our basic
Yeah.
expenses at the time. And I'm like, I can't wait another year and a half to do this again. And the market just, started taking off because of the COVID response boom from the
Yeah.
government and the Fed and all that. So I had three properties that, again, big value add. So we did put a lot into them, but the market helped a lot. It was like, man, there's so much equity in these. What if instead of, holding them and trying to double the portfolio to get to that income number, what if we sell these, take all the equity, put it in our savings, and now I've got this big cushion, this runway
Mhm.
that we can live off this for a few years. I mean, it was probably 3 or 4 years worth that we could live off of. And I'll go try to make this happen. If I don't, I go back to being a physical
Yeah.
therapist. My wife can always find a job as a nurse. Those jobs are out there. Healthcare is not going anywhere.
Worst
Decide to do.
case scenario, you end up where you started.
Absolutely. Right. I mean, for me, I'm like, I've got to at least try this. And so we prayed about that. My wife decided, that was the right move for us. And so she had already quit. Again, she was just PRN and
Mhm.
time working one day a week. And her unit got totally shut down from COVID. And then we started homeschooling our kids that fall. So anyway, she had already quit. So I did. So that was scary. I mean, we had to go find our own insurance, and that's hard to do. Obamacare, whatever you think, like it is harder to just go find your own insurance. I mean, unless you want to get an Obamacare plan, but those are expensive and a lot of times not the best plan. So that was difficult, but we did get that done. We did find some good insurance. And so I went for it. I quit. We put that money in our savings and said, we're going all in. And that next year is when we started syndicating. So we started doing just a little bit bigger deals. I didn't answer one question you asked, Brian.
Mhm.
How do we do those deals, that 16, 8, and 10 unit? We just did simple joint ventures on those. So we
Yeah.
didn't syndicate those. I would just bring in one or two partners. Basically,
Yeah.
they would bring the money and I would do all the work. Now they were active. When you do a joint venture, everybody has to be active, but I did almost all the work. And so we just kind of went 50-50. You bring the money, I'll do the work. And so that's how we did those. But once I quit and into 2021, that's when we started syndicating.
Yeah. So let's talk about joint venture. Obviously, I think from certain standpoints is easier to do if you got
Mhm.
somebody, if you're the sweat equity guy and you got somebody else putting the money forward. Let's
Yep.
talk about the challenges you had moving from that joint venture to a syndication where you're actually raising money now.
We just kind of kept taking the next step, just kind of kept doing the next one bigger. And this was a different time, but also, they were rough properties. And so we were getting them pretty cheap. So I was only having to raise like 100,000 for those deals. So
Mhm.
you can go get that from one or two people, but we took the next step up and actually our first syndication was still relatively small. We only raised 550,000 on the first one, but that was a pretty big jump, almost 5 times what they won before. And so we didn't know just one or two people that could bring that much. Now I think that first one was 7 people. So, it's more people and they're not all going to be active. And so truly that is a syndication. So there's a lot more paperwork involved. And we, do a lot to educate our investors on that paperwork and comb through all that. I mean, the very first time I read every single page, and I think between the PPM, the operating agreement, and the
Yeah.
subscription
You're like
booklet
100
agreement is like
pages there.
120 pages or something. And I read through them all and highlighted and all this stuff. And, it's a good learning experience, but that's the biggest difference. There's a little bit difference in how it operates, but on the joint ventures, we were really operating it somewhat like a syndication that like me and my team were doing all the work already. And then we were, I was presenting to my investors, my joint venture partners. And so a lot of it in practice was somewhat similar, but man, on the front end, raising more capital, it's hard. It's scary. The more you have to raise, the more people you have to talk to, and the more people you have to get to commit, and that's difficult. And then there's definitely more paperwork involved. That's just kind of cumbersome at the beginning.
Yeah. I mean, so raising capital, I was on a panel at a web conference last week, and I was followed by one of the co-founders of Keller and Williams, and I said the same thing. It's hard raising money. And he quoted me and he's like, well, I think it's like single family homes. I mean, Keller Williams, they're a single family home brokerage, franchise type model. But what he said is, is with raising capital, it's the same thing as selling houses. It's either a buyer's market or a seller's market. People are going to be investing, but, using that analogy, I think right now, a couple of years ago, I don't know, are we buyers or sellers as the capital raisers? I don't know. A couple of years ago, it was easy to raise money relatively. Right now, I think you got to spend a little bit more time. You got to spend, you got to talk to more people right now than you did a couple of years ago.
For sure.
Whether buyers or sellers market, I don't know. Am I buying? Am I selling? I'm both.
I mean, this is just coming from a disgruntled buyer, but it still feels like a seller's market to me because, I'm not getting as good, but it's not a seller's market like it was 2-3 years ago. I mean, that felt like a 100% seller's market, where they could just get everything they wanted. It's not like that anymore. Thank goodness. But I hope it becomes more of a buyer's market in the coming years.
I know. I'm hoping so too. I mean, that's one thing. If rates stay high, I think it will become much more of a buyer's market, but I mean, a couple of years ago, it was a little bit easier to raise money, but on the flip side, it was just a different kind of hard. I think when we were putting offers out, the sellers expected hard money the day you signed the contract.
Right. Yep.
And it's just like
we did it several times. Yep.
Yeah. A couple $100,000 that goes into the seller's pocket day one. It's just like, before you even have a chance to look at the property or review financials or anything like that, it's a different kind of hard. I think when you compare and you're just doing the capital raising, that's only part of the deal. Now on the properties that we put offers out on, there's not very many other people in the game right now. You know? So we put an offer out on a property. We closed last October and we were the only offer out there.
Wow. Yeah, that's great. Oh, that's good.
Yeah. So, and when you look at that, it's a lot easier to get the properties. And I'm saying this with a grain of salt. It's just a different kind of hard,
Sure.
But,
that's a good way to put it. Yeah.
Properties out there to put offers on, but the competition has kind of dropped through the floor too. But anyway,
that's helpful.
Yeah. All right. So let's talk about this property management company and some of the challenges you've faced there and how you guys have kind of overcome those.
We, started syndicating in 2021 and built up a portfolio, and we were always using third-party management. We did switch property management companies, and that was a good switch. And the company we were working with was good. But after working with them for a while and having worked with, property management, for, gosh, I guess we were up to like 4 years that we've been working with property management. Just felt like, man, I think we know enough. I think we can do this. When you're managing a little bit bigger properties, or if you have a couple of properties together and you've got people on site, I just started looking at like, well, this girl at our property is killing it as the property manager. This guy is a great maintenance guy. They're doing all the work. I mean, yes, the property management company has to support them and have kind of this back end. And there's a lot to that. I mean, once we built that out, we realized how much that is. It's those two people that are doing it. Like, so I started thinking like, if we could just go get those two people, I mean, one, if they just wanted to stay with the property and come with us, that's one way to do it. And some of them did. And, we talked to the property management company about that. And they're like, yeah, you can offer them and we'll offer them and we'll see what they want. So some cases we just inherited those people. And so it was like, all right, now we just have to, we have to do the accounting on the back end and, some of that kind of stuff and, property management software, but we just need those two people. Like they're going to do all the work. I still believe that. That's why, it's everything's a people business. And so if you get the right people that are on site, so that's just kind of how we started feeling about it, Brian, that, I think we could do better. We're just going to pay so much more attention. For me, owning, the private equity company that raises capital and takes these deals down and has, large ownership in our properties. I just need the properties to do well for my investors, for us. So I don't really need to make a bunch of money or any money off the property management company. I just need it to service the properties well. And that's
Mhm.
not the case, for third party management companies for the most part. Like they need to make a bunch of money off the property
Yeah.
management.
They've got potentially
Yeah,
investors, they've got owners, they've got, yeah.
absolutely.
So
Yeah.
you usually you can do it more efficiently, usually.
Yeah, absolutely. Yeah. And just to focus, I mean, one example, Brian, it was like, mentioned, this girl and this guy are crushing it. Well, one property that was definitely the case. And then all of a sudden she wasn't doing that good of a job. And the property was just like really slipping. I mean, at a time where, it's a little bit, occupancy is a little bit more of a challenge now. Occupancy, nationwide has definitely dropped and it's a little bit softer market. There's a lot of supply coming on and stuff. But this was, a couple of years ago at a time where like everybody felt like everybody was 96, 97% occupied. And we like slipped down to 90% and then below. And it's like, we bought well, Brian. So I'm like, guys, do we need to lower rent? I mean, what's going on here? And that's the time where, rents were just screaming higher. And like, no, that's not the problem. Then we finally find out that she was now managing another property as well as ours. And, that's common. And I guess that's okay. I mean, certainly she wasn't handling it as well because, the
Yeah.
performance at our property was really slipping, but it was just frustrating because they didn't even tell me that. So they didn't
Mhm.
let us know, hey, here's what's going on. And so I think we would have been, better prepared if we'd have known what was going on versus like
Yeah.
just being really frustrated for a month and then finally finding out, oh yeah, well, we're splitting her time half and half. And, they did charge us a little bit less for her, but it was not near enough to make up for the loss in revenue at the property because, our occupancy went from 96 to like 86. So that's the kind of stuff I think, Brian, it sounds like, you've kind of experienced some of that stuff as well. That I was like, man, we would never do that for our property because we were fine paying her entire salary because that's how the property operated really well. So it was things like that. It's like, man, I think we could do this better ourselves.
With the off-site property management companies, there's a couple of things that I look at. You have to have people there. And so one model that I've consistently had a hard time with is the property management companies on smaller properties, right? Smaller properties. You have property managers that are just like, yeah, we can do things remotely. We can do
Mm-hmm.
this. We can do that. I still have a couple of properties that are like under 40 units. This is what I'm talking about. Are these right here where you don't have that on-site presence and you need to. You
Mm-hmm.
need to have
Yeah.
somebody
Yeah.
who's at the property consistently.
Yeah.
If the property is large enough, you can have somebody there full time, and that's
Mm-hmm.
that's that's the type of management that where things get a
Yep.
lot better. We have
Yep.
somebody there persistently, but
Yep.
yeah, when you come down to the property management companies, like you said, I mean, we've had property managers, overburden their leasing agents, where it's just like, well, she's running 6 different properties, and this one's
Yeah.
only so many units.
Yeah.
It's like, well, we're paying you for a service. I mean,
Yeah.
but that's the rub, and that is the
Yep.
real rub. And I think you ended up, bringing somebody on staff, paying them full time, having them do
Mm-hmm.
one job, and
Mm-hmm.
for you guys. And
Mm-hmm.
I mean, how's that working out?
Overall, really well, Brian. I've really enjoyed building a team. I mean, I'll tell people like when you hire good people, it's really fun. Now, it can be hard to find good people for a good price and all that. I mean, so it's
Yeah,
challenging. And then people are, emotional and sometimes irrational and sometimes they fight with each other and, stuff like that.
yeah, it
So,
happens.
I mean, I do all those things myself. So, it's just, yeah, you're dealing with people. And so that can get messy. But yeah, for the most part, we've got some great employees. I mean, I actually, I think all of
Mhm.
them are pretty great. And, they've got their quirks, but it's been really fun building it, and they've done a great job. And yeah, we've been able to charge the property a little bit less than the property management company was, and we're performing better. So it's been great. We control expenses too. That's another thing, Brian.
Yeah.
Property management companies typically they're just incentivized to raise revenue, not really decrease expenses. And so we were always actually pretty impressed by their expansion of our revenue, but always very unimpressed by how much our expenses kept going up. Right. So
Mhm.
they weren't incentivized by NOI. They were just incentivized on the revenue side. So, for us, it's different. We just care about NOI. So if revenue doesn't go up, but expenses go down, we're cheering, right? That's just as good. And if we can do both, that's the best. So it really has gone well. There was a lot to it. I mean, I'll tell you, if someone's asking me if they should do it, I would say, yeah, but I mean, buckle up. It's like the first 3 to 6 months is a lot. I mean, we went with, Appfolio as our property management software,
Mhm.
and it's great, man. It's just a lot inputting all the properties, figuring out the accounting and bookkeeping side of things.
Mhm.
That's a lot. And the legal side, and then yeah, having employees, benefits and workers' comp, and just it's just so much to it, man. there's no comparison in how much the logistics side and like I don't know, the back end stuff of like starting a private equity company that just buys asset, that's so minimal. I mean, you could do that by yourself to some degree. It's just a lot starting a property management company. So it was a lot, but overall it's really going well and I'm glad we did it.
Good. Yeah, it's something that's kind of in my plans. I mean, former company I was with, that was kind of one of the last things we did, before I left the company. And when I say we, honest truth is the way that happened was kind of part of the reason I left the company. But we'd always planned on bringing that property management in house, and now that we've focused on Salt Lake, we've got some traction there with some properties there. Same thing we're going to do eventually is bring that in house. But
yeah,
I'll probably pick up the phone and give you a call and say, all right, Lee, what do we got to do now? What do we got?
That's what I was doing. Yep. Yeah. I was meeting with, several guys and talking to people on the phone, and got a lot of good advice. So I'd be happy to do it for you, Brian, when you're ready. You guys will do a good job at it.
Awesome. All right. So what's coming up for you? What's next on your guys' radar and in the near future?
Yeah, I hope, Brian, to just continue building the portfolio. So, we only have 350 units. That's pretty small. I don't know. I'll hear a lot of guys and girls say, hey, you get to 1,000 units, then you can bring property management in house. And so maybe we did it a little bit early. And I will say, one sign that maybe, again, I'm happy we did it, but one sign that maybe we did do it a little bit early is, even though we basically have 3 properties that are almost 100 units and then a 64 unit property, and they're spread out. So they're between Cincinnati and Dayton, and they're, for the most part, like even 40 or 50 minutes apart from each other. So, we've got a full-time property manager on site at each one, basically, and a full-time maintenance guy on site at each one. If one of them is off, it's kind of too far from another property for them, to kind of help each other out. And then as far as, especially the maintenance guys kind of being like, they kind of have to be on call in case someone calls. Well, it'd be nice if they were close enough where it's like, well, hey, you guys can switch off and on, like you're on call this week for both properties and the next week this guy. But if they're not close, then that's not really going to work. So we want to buy more assets. We want to bring on more investors, buy more great assets, and just continue building a portfolio. And that'll really help us on the property management side to get them close to each other, because we have a 64 unit and a 96 unit that are 20 minutes apart. And that just works out great. Those maintenance guys help each other out. They can come over. Hey, this property, we only have a couple units vacant, but this one, he's got 4 right now. So we want to send this maintenance guy over here to kind of get these units turned a little bit quicker, help them out, stuff like that. But then again, this guy's on vacation. Okay, easy. This guy can cover. So for that reason too, on the property management side, it's going to be great if we can continue building our portfolio and buying properties close to our other properties. So we're always looking for good deals, and we'll buy where the good deals are. But the more we can build up our portfolio, I mean, that's how we build our company internally and build our investor, and just kind of keep building. So I'm loving it. I mean, I still pinch myself sometimes that I get to wake up and do this type of stuff every day. I mean, the fact that I get to hang out with you, Brian, and call it work, and it is, because it's beneficial to go on podcasts. It's just great because I love doing this stuff. So we want to keep doing more of the same, bringing more people along with us, just like you guys are doing out there in Salt Lake City, Brian, and building a portfolio. And then that builds our property management company, and they kind of, service each other.
Yeah. And something you mentioned, distance, that was something that I underestimated when we first started doing things. We started buying things in South Carolina, and South Carolina is not a huge state, but it's not a small state either, and our portfolio was kind of shotgunned across the state. And we're talking, it wasn't 20 minutes between properties. I mean, we very frequently had 2 properties kind of close to each other, but I think we had 2 properties in Spartanburg, 2 properties in Clemson, 2 properties in a town called Pickens, but the distance between these clusters was an hour and a half drive. It's something that I think a lot of people don't realize. Even if you're buying in the same metro, distance does matter. And so we have in Salt Lake, I mean, if you look at the greater Salt Lake area from like the northernmost point to southernmost point, you take it 2 hours to drive, and you wouldn't want to have both properties with the same staff. But it is definitely something that I think I underestimated going in, was the distance between the 2 properties. It's like, oh yeah, we have 2 in this city and then 2 in the next city down, but if they're 2 hours apart, sometimes we would frequently on that portfolio have 2 or 3 different management companies running different properties, because one of them only did Greenville and one of them only did Spartanburg,
So I had to do that as well.
All right. Well, let's closing up here. I got 2 more questions for you. Giving advice to somebody who's just getting started with their multifamily career, what would that advice be?
I'll say three quick things. One, we talked about networking. I mean, I think that's so important. Just getting out to some of these meetups and learning from people who have already done what you want to do is so important. And then the other thing I would say is just have a long-term view. I love the book, The Compound Effect. There's other, you can find videos of people just talking about the compound effect and how that works. And I think, people will say like our minds aren't really trained to think in exponential growth. We think linearly. So most people think like, okay, if I can do a single family this year, maybe I can do another one next year, and maybe one after that, and then duplex. I mean, and they just think in maybe 10 years from now, I'll buy 2 or 3 single families in 1 year. Well, that's fine, but you can actually do way more than that. And actually, it's going to be slow in the beginning. But man, if you build up momentum, one of my favorite quotes, I don't know who actually said it, but we overestimate what we can do in a year, but we underestimate what we can do in 5 or 10. And I think that is so true. Some people get excited like, man, Brian, I want to do what you're doing. I want to quit my job. Can I do it in 3 years? No, probably not. I mean, that's great. Like if you started in 2019, or 2020, right? But
I started in 18 and I was, out of my full-time job in 3 years. But yeah, I think right now you'd have to probably pad that by a little bit.
Oh, for sure. I think it'd be very difficult. I mean, depends your risk tolerance and stuff like that. But so sometimes people think like I can do it a whole bunch like really quickly. Well, no, you can't. But you're going to shock yourself on what you can do in 10 years if you really stick with it. So if you get that mindset, I think that gets you past like getting frustrated early on because you might work for a year to get your first apartment building and you've still got nothing and you feel like, well, I've done nothing, and it's not even true. And then maybe another year you go out and find 2 apartment buildings and suddenly you have 150 units. Well, you didn't just go from 150 units in year 2. It was year 1 that was getting that done. And then, man, once you get a couple, it's, now the brokers, now the debt, now you've got investors, and you start rolling. So you got to think that way and just be patient with it. And but none of that gets going unless you get started. So that's the final thing I'd say is like you do have to jump in, and jumping in might start with, again, going to some meetups. But then jumping in is going to be put some money in a deal, invest in, one of Brian's deals to see what that's like. And then eventually start making offers yourself. I mean, you just got to take some big steps. You got to take big action.
Yeah, absolutely.
Get it going.
Absolutely. All right. Last question. How can listeners learn more about you?
I try to be pretty active on LinkedIn. So if you look up Lee Yoder on LinkedIn, you see me there. I'm on Facebook as well, Instagram sometimes. And then our website is threefoldrei.com. That's THREEFOLD REI as in realestateInvesting.com. We got a bunch of stuff there, some free education and whatnot. You can contact us through the website.
Awesome. We'll make sure that hits the show notes. So anybody listening who wants to learn more about Mr. Lee Yoder, definitely check that out. And so, Lee, thanks for coming on the show today. Very much appreciate your time.
Thanks for having me, Brian.